Russia confronts economic headwinds as an overpowered Rouble threatens export dominance. Russia is entering a complex economic chapter as its national currency. Ruble strengthens far beyond expectation, an unexpected development emerging in the shadow of US Russia negotiation and the shifting geopolitical dynamics. Senior Russian official now warned that this rapid appreciation, driven partly by monetary tightening and investor optimism for a potential diplomatic thaw with Washington, risks undermining the very structure of Russia's export anchored economy. Since January, the ruble has surged by more than 46%, a trajectory that contradicts forecasts from industry analysts who long argued that the currency natural value hovered near 100 to the US dollar. Instead, the ruble now trades around 77.5, unpending business planning for Russia's most critical commodity exporters, firms whose revenue from the fiscal spine of the state. Oil, gas, metals, and grain producers, the crown jewels of the Russian economy, are now grappling with shrinking profit margin. Because these sectors price exports in dollar while incurring many domestic costs in rubles, a stronger currency directly compresses earnings and tax contribution. Economy Minister Maxim Reshtnikov, speaking at the Russia Calling Investment Forum, acknowledged that the government expects the stronger ruble to persist due to weak imports, diminished capital outflows, and a surge in ruble-dominated trade. Strategically, the exchange rate will be stronger than we assumed 1 or 2 years ago, he said, noting that Moscow had already revised its 2026 forecast from 100.2 to 92.2 rubles per dollar. He warned that several massive state-backed industrial ventures collectively projected to generate up to $70 billion in exports may no longer be viable. Among them are high-profile projects such as Sibur's Amur gas chemical complex, Gazprom's Ust-Luga processing facility, and Alisher Usmanov's Udukan copper mine. Crypto capital controls and the diminishing role of the dollar. Adding another layer to the puzzle, Kremlin economic aide Maxim Oreshkin pointed to the rise of cryptocurrency mining as the surprising contributor to diminishing foreign exchange demand. With digital assets increasingly used to facilitate certain imports, Russia has found new channels to bypass traditional dollar-based trade. Government policy restricting foreign goods, from higher scrappage fees on imported cars to curbs on grey imports via Central Asia, have further reduced dollar flows into the country. At the same time, Russia's high-yield government bonds offering return around 13% have lured cautious foreign investors back into the market despite Washington-led sanctions, a testament to how global capital often dances to the rhythm of US policy but moves where profits beckon.